Well, good evening, ladies and gentlemen, and thank you very much for being with me today for this Danielcode webinar. Great pleasure having your company. And it's good morning to our friends on the east coast of Australia, a little bit later to the rest of the country, and across the ditch, of course, to our friends in the land of the long white cloud. Well, what a burst of trading today. I mean, inside bars be damned, they're outside bars forever, all over the charts, as many as you can count. And of course, that caused, no doubt, some real ructions with your trading. What I want to show you today, though, is that trading was still highly manageable and highly profitable if you were able to control yourself and stick to the Danielcode rules, which we'll talk about a bit later. But I wanted to start off here. We've called today's webinar The Other Way. And the other way, of course, is Danielcode Time. And I've just last week wrote an article. I've been writing it for a month or two, actually. And it's basically a dissertation, if you like, on the reality of time signals. And we've taken the S&P 500 as our test subject, being the most broadly accepted measure of market wealth. And we've taken both the futures contract and the index itself. And what we're going to show you is it's quite extraordinary. And I hope you'll take the time to read that article. It's a fairly heavy read because it's chart heavy of necessity, but it's all explained absolutely fully, very transparent, and amazing is the only word. I've been at this business for 30 odd years, as most of you know, and no one is more amazed by this than I am. So let's dig right into it. Markets are rational, orderly, and sometimes predictable. And of course, the Danielcode is a set of proprietary ratios that control time and price in all markets. And what you need to know about it is that uh, everything that we do at the Danielcode is actually based on time. So we take our basic unit of time, which the Danielcode we say is 29.6, or we could say, if you wanted to make it more clearer and more exact, we take the length of a synodic month, which is basically the average length of all of our months. And as I'm going to show you later on, what happens after the decimal point doesn't really matter for a couple of reasons, but we'll get to them. In the meantime, let's get started with what we're looking for here. Okay, just a moment, and here we are. Okay, so here it is. This is one of our 6-day charts. You've seen it before. Some of you have seen it many times before. And basically, this is the high in October 2007 and the 2007-2009 crash into March 2009. And this is a 6-day chart of the index. We use both the index and the futures for our work. And how this all started, and I guess how my interest in time signal started, was right on this chart that we noticed going into the 2007 top that we had a swing high to closing high of 59 days. Well, 59.3 is twice the Danielcode measure of time. In other words, it's twice 29.6. And we noticed that 59, we don't, as I say, have to worry about the decimal points when we're talking about time, because quite simply, there's 104 bars missing for weekends, and another 12 or 13 or thereabouts. I think we've got an extra one now called Juneteenth. There's our market holiday. So we've got almost 32% of bars are actually missing. They're not there. So we're taking 360 degrees of data and forcing it into 255, 256 days of time trading days. So the most we can ever hope for is to say that these time cycles are accurate to plus or minus one period, which is minimal, given that we know there's almost a third of bars not on the charts. We should have a statistical error of 30%, and it should be a systemic error that's there all the time, but it's not. You'll be amazed how accurately these time cycles work, literally to the day, and sometimes swing high to swing high, closing high to closing high. We distinguish between both those measurements, as you'll see. So I saw this, and we looked to see it repeat at the March 2009 low, which it did. And there's nothing so new about this. I wrote an article about this way back in 2009 that was published by Financial Sense, and it was called The Number of the Beast, because that low of the index was 666. And I was running a tutorial in Taupo that weekend, Taupo, New Zealand, beautiful New Zealand. And the article tells you all about the strange and amazing things that happened while that tutorial was going on. Let's move on, and this is the knock you out punch. If you have a look at the two areas that I've shaded in pink, the first one is the correction of October 2018. This is the future chart now. And that was the biggest correction since the 2009 low when it happened. It was a significant correction. A little while later, March 2020, we got the COVID flash crash, which was really great fun if you were trading it as we were. And what you had was the shortest bear market in history, 23 days, pretty much straight down. And then it recovered and went on to make new highs. And the amazing thing about that, if you think about it, I've got two lots of timing cycles on this chart. The top one is 59, and it simply repeats again at 118, twice 59, and that gave you the high of the October 2018 correction. Excuse me, bit of hay fever in the morning. And then below that, you've got another time cycle, the same time cycle as 59 again, but it comes from the March 2009 low. And that gave you the high of the COVID flash crash exactly. Now, if you think in terms of the easiest way to understand time cycles is to see one time cycle happen and look for it to repeat. I know a wise man said, markets don't repeat, but they rhyme. Well, he obviously wasn't a futures trader or a forex trader, because these markets repeat their time cycles all the time. It's the most common form of price action. And we know how price moves, or time, I should say. We know how time moves. It repeats, it expands, and it halves. And that's all it does. And it just goes on doing that on and on and on, as I hope you'll be able to see as we go through this presentation, and more particularly if you will make time to read that article, which is available on the website under the articles tab, or on the front page there's a link. How amazing that this dreadful, dreadful disease that killed millions and millions of people, it didn't matter until the 59 cycle had expired. Then it mattered a great deal. Then it was over, and it didn't matter at all as the market went on to make new highs. I mean, how is that possible? You couldn't dream about it, but there it is, stark reality of it. Markets controlled by time. Well, it's a silly thing to say, but that's at least one conclusion that you'll draw from what you are seeing now. Let's move on. This is just another view. This is the index. Same thing, we're still running from our benchmarks back in October 2007. We've got a 59 cycle running along the bottom of these two horizontal lines, and at 1.5 times its 59 bar cycle, it gives us 1 bar before the high in January 2022. So as I say, plus or minus 1 bar is about as accurate as you can hope for, and what's amazing is that these are more accurate. The top line is 79. Now, almost all of the time cycles that we use come from the Danielcode sequencing. 29, 44, 59, and it progresses by and half all the time. 79 is not one of the Danielcode numbers. What that is something the market's shown us. And what happened was when we were measuring the .com high to the 2007 high, it was 80 cycles. And when I did the same thing on the index, it was only 79 cycles. Well, what's 1 bar? It's not even a rounding error. But it's important because it's the market telling us something. And this is what it was telling us. Take that 79, which came from the .com high to the 2007 high in the S&P, run that 79 cycle, and at 1.5 times that cycle, you get, at 1 I should say, see the little number 1, it's 158, it's got a 1 against it. That's actually a 2. It's just the way this timing program works. It doesn't count the first section itself, so 1 is actually the first repeat of the time cycle we selected, which was 79. So there we are with 2 timing cycles on the 79, exactly to the bar, gives you the low of this whole correction in November 2022. Amazing. Shouldn't happen, but it does. And what's actually happening now is these 2 corrections from September 2018 and March 2020, they have become the bulwarks. They have become the new pillars for timing, I suspect. And I think we're showing that to you here, that we're quite simply running the first cycle. We're running a 44 cycle, which is the cycle after 29 and before 58, or 59.3. And at it shows 1, which is actually twice, it's got the number 88 there, 2 lots of 44, which is one of the basic Danielcode cycles. You get the low in October 2022 on a 12-day chart. How did we get that? Well, from that high in September 2018, the 44 cycle gave you the first significant correction after the March 2020 low. So it's telling you that there's a cycle there, and it happens to be 44. Watch that come in, then look for it to repeat. And it does. It gives you the low in October 2022 exactly. On the lower line, horizontal line, we're quite simply running the Danielcode basic 29 cycle from that same high in September 2018. And you can see as it moves along, I'm sorry, we're starting from the momentum high of March 2020. It's that intermediate line. We're running it at 29. At 44, it doesn't give us anything. At 88, it says 1. That's in fact twice. 44, it gives you the low right on top of the previous signal we had. Quite extraordinary, isn't it? And what we're actually doing with the bottom line that is easy to get confused with is that that's a 70 cycle from the September 2018 high. One of those 2 highs that was identified by the cycles. Here's the 70. It's been running since Black Monday, back in, way back. Was it 75, 78, something like that? Their 70 cycle bang straight onto that bar that on this chart, the 12 cycle chart, you can see how it changes subtly. It's now giving you on this high is the closing high of the whole move. Very important, the closing high. And it's picked up on the 70 cycle. None of this should happen. These bar positions, highs and lows, are all supposed to be random, but they're not. And let's have a look at this fella here. This is the S&P E-mini futures contract again. And what I've shown you is, I couldn't fit it all on the chart and make it legible at the same time, but I can assure you it's correct. We've taken that 79 cycle again that we've just identified by the difference between the cash and the futures, and we put it on the futures, and 3.5 times that from the March 2009 high gives you the January 2022 high. That's the swing high exactly. And 7 times 59 from the October 2002 high. There's the .com high. Can you believe it? It gives you this high in 2022. The .com high gives you in 2000, and this next high in 2002 gives you the high, the all-time high, 20 years later, and there it is. Have a look also at the cycles down the bottom here. And all we've done is we've taken the 29 cycle, the most basic time cycle. We've run it from the September 2018 high, the March 2020, that was the COVID flash crash high, and the smaller correction before September 2018 to show that they're all related and none of this is random. From the high on the January 2018 swing high, 3.5 times 29 gives you the October 2022 low. Exactly. From the next one, the September 2018 high, 3 times 29 gives you October 2022 low. Exactly. From the COVID flash crash high, 2 cycles of 29, which you know is 58, we looked at this another way, gives you the current pullback low. As you can see, the market's moved on considerably. Some of this work I was doing some time ago. So some of these charts are a bit old, but the length of time it took me to work all of this out was massive. It was a matter of months and months, really. So there we are. Let's move on. This is actually something quite different. And what I'm showing you here is that we know September 2018 is an important swing. We know March 2020 is a vital swing. What I've done here is I've taken a 29 cycle. I've actually pushed it down one to a 14 cycle. 14 can be half 29 or half of 28. In this case, it's a pure 14 cycle. And what's interesting is that on the 62 cycle, that pretty much gave us the low before the final low. And you've seen where that light blue arrow is pointing up at 1022. That's from the previous chart. But it shows that middle swing is important. We've already proven that the swing before September 2018 is important. We're now looking at that swing in between. Move along to the price on the right. You can see this chart's ripping up, and it's going through its blue line price targets, which are actually time cycles expressed as price. This is a 12-day chart. It's got some real momentum up, and it's heading for the Danielcode black line, the famous black line, which you can see sitting there at 4664.25. This is, as I say, is the futures chart. So the Danielcode black line is the final support, the last support or resistance for any swing. In this case, it's the last resistance. And if we got a daily close above 4664.25, that would move the probabilities massively in favor of the swing being taken out, the swing being up to January 2022, and then as a result of that, all-time highs. And we have 2 cycles, time cycles coming up. You can see the blue arrows, and there's one next to the other because these 2 cycles are 1 period apart. Again, this stuff is accurate to plus or minus 1 period. So having cycles next to each other is not at all unusual. And they're coming up. One's about mid-August, the other's late August, might be early September. And we'll talk more about that as time nears. but there you are. Let's have a look at price, because this is so unusual. It concerns me. And we know that the October 2007 down to the March 2009, the final leg of the 2007 to 2009 crash, we know that measurement's important because we've been running time cycles off that high and that low, and they've all been hitting pretty extraordinarily well. Have a look what happens if we simply take that as a measure of time and extend it back up with the Danielcode numbers. And the first one we came to that is significant at 1.593 gives you, as you can see, 1, 2, 3, 4, 5, 6, 7 little highs there it's holding back, and then you get another one for a retest later on. But that's significant at 2133. The next level up is 3 times that same leg, 2007 high to 2009 low. 3 times that relationship gives you 342875, pretty much exactly the COVID flash crash swing high on the 24-day chart. And the next level up, which is 4.5 times, exactly that same measurement, we haven't changed that at all, comes in at 481025. Pretty much the all-time high. So accurate, so neat. I mean, is this what you expect to see in markets? Markets are supposed to be random. This stuff is all supposed to be emotionally driven, economically driven. I suspect very much that it's mathematically driven because it's just so accurate. Let's go one step further. Here's the retracement. And I have been saying to you all the time that this retracement has been very mild, it's been very well-mannered, it's not been violent at any stage. We've not seen any of the violence we expect to see in bear markets. And look what happened. From January 2022, the all-time high, down it came, and it first found support at 35.6250, which is exactly 50% of the minor swing, which runs from January 2022 down to the January 2019 low of that same swing we've been talking about and identifying as important. Then it slipped through that, and it stopped like it was shot at 34.9125, which is exactly 50% of the dominant swing down to March 2020. How accurate, how perfect, how amazing. So when I tell you markets are rational, orderly, and sometimes predictable, you never thought I meant this ordinary. You never thought I meant this organized, because these markets are organized, as you can see, with the way I'm presenting this stuff to you. Okay, special end of financial year sale, plus 1 month. It's the first time we've done this, folks, but we'd like to give you the opportunity and some benefits of using some of the Danielcode signals, TO3 signals, TO3 plus signals, or the fourth seal commentary from Frank DB. Very important now, more important than ever. The success trade signals, members charts, which are the heart of Danielcode, the Danielcode tutorial, everything you need to know to become an elite trader, creating your own Danielcode time signals, creating your own Danielcode price signals. We're more than happy to offer you a 20% discount on anything. And that's available until 12th August. So act now. If you're interested in the tutorial, send me an email straight away, please, jneedham@thedanielcode.com. I can only take 4 people for this next round of the tutorial, and at that discounted price, that's all we're able to accommodate. Let's have a look here. This is the services page at the Danielcode website. All of the services, but not the tutorial, are laid out there. So go to the services page, see what you like, click the link with PayPal, start your subscription going. And as soon as you've done that, send me an email, jneedham@thedanielcode.com. Tell me, I've just subscribed, I want to take advantage of the 20% discount. I will have the 20% refund back in your account the same day. Now, bear in mind, your day is my night and my day is your night. I'm at the other end of the world to most of you, but I will have that 20% refunded from anything you decide to sign up for before the 12th of August. And in fact, with these subscriptions that are month-to-month subscriptions, we're going to give you the 20% discount for 3 months. So remember to email me, tell me that you've done that. You're taking advantage of the 20% special sale discount. I will have the refund in your PayPal account within 24 hours. Okay. Here's the next thing. This is the Danielcode tutorial. So important, folks. If you want to learn to trade, go and find the money. Beg, borrow, or steal. This is reduced from $7,500 to $6,000. You get a $1,500 discount. We haven't done this since December when we took another 3 people. And that's the 3. We can maybe take 4. Be sure to email me straight away if you want to take advantage of this, because I do all of these tutorials one-on-one personally with you. So there's a limit to how many I can handle at any one time. But have a look. There's a link there for the curriculum. Click on that link, or you can go to the Danielcode website and click on the Learn to Trade tab. That will tell you the curriculum, tells you a whole lot about what I'm going to teach you. And then if you're interested, ask me for the link to see how our video tutorials work. And have a look what people have said about this. We've got a member, and he's with us today, Greg Palladini. He's a very, very good trader. He's a master trader and a wealth fund manager. And he lives in California, but he's been kind enough to allow us to use his name, which we would never do without express permission. But more than that, he's actually diarized his adventures doing his second Danielcode tutorial to learn about trading time. This would now be 2, maybe 3 years ago. And he's listed a whole bunch of entries under our tab forum, which is our discussion page there for members and guests. And he's given his comments of how he enjoyed the webinar, how he enjoyed the tutorial, I should say, what he learned, what was good about it, what was bad about it, and read what he has to say. Continues to provide the confidence to trade big, while the great unwashed still trade on the news. Clueless as to the Danielcode numbers. It's all good, or should I say great for us. And as he says, trading with the Danielcode methodology gives you certainty, confidence, and success in the biggest financial markets in the world. Wonderful stuff. Don't miss the opportunity. Do it now. Once you've done this, you will have it forever. It's a forever gift that goes on rewarding you. Markets want to reward you. Markets are there to reward you, but you need to know their language. And until we got the Danielcode, we didn't understand that language. We do now, and you can take advantage of that. So jump on that. Email me straight away, jneedham@thedanielcode.com. Okay, let's talk about time, and I'm going to give you a fairly offbeat presentation of this, simply to try and get you to start thinking about time the way I think about time. And the synodic month is the formal name for the cycle of the moon's phases. And the length of a synodic month is 29.53 days. Well, let me into a secret. It's not really. That's the average of the averages. And this is nearly 2.2 days longer than the sidereal month, which you don't need to know about. This phases of the moon is called a lunation. And lunation itself actually varies from its mean value by up to 7 hours. And I've calculated it for you, I think. The table below contains details for all lunations. In 2001 was when I found you to start with. And what's interesting is you're going to see is the length of these lunations, or length of this synodic month, they vary. And that's because as the moon is orbiting around the Earth. It's our permanent satellite, isn't it? The Earth itself is on a much, much bigger trajectory. It's orbiting around the sun. And as it moves through that orbit, so the length of these synodic months change. And you can see here, the longest synodic months you can find is 29 days and 19 hours. And that was January in 2001. By the time you get down to July, it's no longer 29 days and 19 hours. It's now 29 days and 7 hours and a few minutes, 11 minutes. And that is just a very significant discrepancy, which is why I say to you, don't fret about the 0.6, the 0.5s. It doesn't matter because, first of all, you have that consistent almost 30% of bars missing. But as well as that, the synodic month itself, which is the most accurate scientific method we can get, is an average of the averages. And as you can see, they move around. Look what happens if we move up to 2023. This is the same material. Now you've got the longest bar there, period, the longest lunation is 29 days, 16 hours and 15 minutes. The shortest time of the lunation this year was February. The top one's out of line. Excuse me, 29 days, 10 hours, 13 minutes. That's a little bit faster, isn't it? So that's the shortest. And the longest is 29 days, 16 hours, 15 minutes. So there's that 6-hour variance. Not an insignificant difference. And that's what happens with markets. This hour that you're living in now is not exactly the same as the last hour, nor is it exactly the same as what the next hour will be. All of these time cycles move a little bit, but all having put all of that together, the fact that they're so deadly on marking the major turns in markets is the most amazing thing. Staggered me when I started finding this stuff, and still does. And it gets you excited to go on and find more and more and more. And this is one of the things I found that I find very interesting. We always have people who say they don't know how to trade or they have trouble trading. Think of this as the gift to you, the gift of markets. This is there to make you wealthy, happy, and healthy. That's what it's there for. Have a look at this here. This is 1 year of S&P 500 futures with lunations. It's got the black dots are the new moon. I did have a beautiful bright yellow, but you can't see it on the screen, so I've changed it to a sort of fluorescent green. That's actually the full moon. Have a look at that. Just have a real quick look, run your eye along it all. Immediately something should strike you. They're all at highs. They're nearly all at highs or near highs, aren't they? Why is that? Well, I don't know. But that's where they are. Let's look at that more deeply. Perigees, apogees, and perigees. If you have been with the Danielcode for a while, you know all about them. I talk about them often. The moon is in orbit around the Earth, and it's an elliptical orbit. It's not symmetrical. So there are times in that orbit when the moon gets as far away from the Earth as it's ever going to get on that cycle, and that's called an apogee. And the other end of that is where the moon gets as close to the Earth as it's ever going to get on this rotation, and that's called a perigee. Take a look at the apogee and just see that dotted line, which is not accurate by any means. It's just to illustrate the moon's elliptical orbit. But see what happens. You can start the moon anywhere you like, somewhere near the Earth in the middle on that line. It moves out, all the way to the apogee. And all the time it's working its way out there, its gravitational pull on the Earth is being reduced. Then it gets to the apogee, it passes that point, it turns, and it's now coming back towards the Earth, which means that its gravitational pull on the Earth is increasing. And that gravitational pull is hugely significant. That's what gives us tides. And that gravitational pull is dragging billions and billions of gallons of water right around the world. Amazing. You want to see how amazing? Get a bucket of water, just a normal bucket, 9-gallon bucket, fill it up, hold it out with either hand at right angles to your body. See how long that lasts. Okay? Water weighs about 10 pounds a gallon. Have a look at this thing. This is dragging billions and billions of gallons all around the world. It is a very significant period. And what's most significant is when this gravitational pull changes. It changes from going away from the Earth, therefore weakening, weakening, weakening. It makes its turn. It's now coming back closer to the Earth every day, every moment. The gravitational pull is getting stronger and stronger and stronger. And at some point here, it reaches its perigee, which is as close as it's ever going to get in its rotation around the Earth. And at that point, the gravitational pull is being reversed again. It now goes from gaining to losing. It's gone through that point. It's now coming back towards the Earth. It's starting to grow its gravitational pull. Okay, apogees and perigees. Let's just slap them all on the chart here. Forgive the odd P up the top there. That was something that the program, which is by no means automatic, it's mainly finger pointed at, it didn't find anything in the same way. You've got one big black dot there. That was a new moon I had to insert manually, and that all looks a bit weird. But look again, apogees and perigees, just about near the highs. Almost all of them. Have a look at this. Start with this. Here's your high. Down it goes. Perigee up to this new moon, full moon. Down it goes. Apogee, a little rally up at the apogee. Down it goes. There's a new moon. That's a little high. Down it goes. Here's the perigee. Down it goes. Here's the apogee. Forces it up. Then there's one bar down. Up here, hits the new moon. 3 bars down. Hits the perigee. Down. Hits the new moon. 1 bar down. Hits the apogee. Down. Hits the new moon, and the perigee's right beside it this time. Down. Here's this mad blow-off little spike up here. Happened to be 1 day after an apogee. That stopped it. Down it goes. Perigee at the high. Apogee at the high. Perigee at the high. Apogee at the high. New moon at the high. Full moon at the high. New moon at the high. On and on and on and on. This stuff's incredible. If you've never thought about it, this is part of your life. Of course, with the signals we create for you, they're a whole lot more accurate. But this is a phenomenon that you at least need to be aware of. As you approach one of these time cycles, expect a change in direction. And if those guys are all monopolizing the highs, what's handling the lows? Well, you'll see some numbers here, 1 and 3. 1 is the first quarter. 3 is the third quarter. In between them are the new moons and the full moon. And these are predominantly on the lows. Here was this low all the way down here. Pushes this big rally up here. 3 doesn't do much, just continues it. 1 pushes this rally up. 1 pushes this rally up. 3, 3-day rally. Here's your number 1. Big blow up here. Here's your 3. This was the low. Very important. Pushes it up. Here was 1 bar from 2 bars from the high and 2 bars from the lows, affecting both of them. Here's your 3. Causes a rally. Here's your number 1. Causes a rally. Here's your number 1. Causes a rally. Here's your number 3. This is all getting a bit congested here, but it keeps pushing that high up. Here's the number 3. Up to that high. Here's the number 1. You can barely see it. It's right on that 1 bar up. Here's your number 1. 2 bars before the rally. Here's your number 3. The big rally from this low. Number 1 does the same. Number 3 does the same. Number 1 does the same. Number 3 just holds that high through that block. Number 1 gives you the next push up. Number 3, that's the gap in this big run up move here. Wonderful stuff. Number 1, right at the low. Number 3, right at the low. Number 1, who knows at the moment, but it certainly is a low because it's got a higher bar either side. Markets are trying to talk to you. Markets are there to reward you. Markets are there to make you wealthy and healthy and happy. And those are all good things. Okay, let's keep moving. Something a little more subtle. If we simply take the 29-degree out of all these moon phases, just slap them straight on the chart, you can see that they almost all identify with important highs and lows. We can go a little bit further than that. Now we've got a couple of black ones on. The red ones are all the 29 degrees. The black ones are the 89 degrees. And there's one, excuse me, blue one right at the bottom there. That's 62. That's the one next to the 59. That's the alternate to 59. There you are. Nature at work. You can learn this stuff. You should be aware of this stuff. Apogees and perigees, new moons and full moons, all there. Okay, special, remind you again, folks, end of financial year sale, 20% off everything you can sign up for before the 12th of August, including the Danielcode tutorial, which has had a reduction especially for this sale of $1,500, so it's now $6,000. Beg, borrow, or steal, get yourself qualified, teach yourself this. It's a lifelong gift, and you will make a lot of money. Okay, turns. Thinking about turns, turns by definition are against the apparent trend when they happen, and that's why they have a pretty significant failure rate. So these flip me signals that I've been speaking to you about for over a year, that's what happens when you've had a valid Danielcode price or time signal that has been elected. We say elected, it got to the number we said it becomes valid at, and we put that in our trade program. Within 3 days, if the failure point, the initial stop loss on that position, if that's breached, it's telling you something. It's telling you that you're wrong. And if you're wrong, you need to do something about it. And that doing something about it is flip me. If you're long, you're going to flip to short. If you're short, you're going to flip to long. And with yesterday's, or today's, I should say, amazing difficulties with trading, that's going to just show you how important flip me is. Have a look at this. This is Danielcode target recognition plus trade technique. Some of this stuff is just very basic, matter of fact target recognition. The markets know these Danielcode numbers and they track them. And you can see here we have target recognition. This close is right on that blue line almost exactly. And it has to be almost exactly. In fact, it has to be within 0.1%. Not 1%, 0.1%, 1/10 of 1%. That's what it has to be to give us target recognition. And the markets do it. It's hard to do, but they do it. And you'll see some extreme examples of it. Right here, this is talking about flip me. This is not a current chart, but it was from a previous webinar where I talked to you about this. You had a TO3 plus buy signal that was elected. Means you were long. And your stop loss, your preventive stock on that trade is 2 ticks below either the inside bar or its previous bar, which was the signal bar. Both are valid. If that stop loss is breached, that is the point for flip me. You're wrong, you're long, and you're wrong. You need to do something about it. You need to get short. See what happens over here. Here we are. Crude oil. This has run into a period of massive consolidation of the numbers, not of the market, of the numbers. But you can see, usually someone says something silly like, well, if you put enough numbers on, you're sure to hit one of them. That's not the point at all. And we're not even looking for that. What we're looking for is how the markets react to that number to give us target recognition. Have a look at the first target recognition I'm giving you there with the arrow on it, and that runs up into the high of 79.29. It hits that number, and then it runs away from it to stop at the close, to leave its high within a handful of ticks of that number. The market is speaking to you, and what it is saying is, I know these numbers and I'm tracking them. The next day, we get no target recognition. The next day, we do get target recognition. It's the high of that little inside bar, which went to almost exactly 79.77, plus or minus just a handful of ticks. Have a look at this last bar on the chart, today's bar. This has run up through a lot of these blue line numbers, and then it's run away from it, and it's worked really, really hard to close at 79.77 within a couple of ticks. That is not easy for markets to do, but that is target recognition. And target recognition of itself does not guarantee a turn. But if we look at that from the other side, what we can say is without target recognition, you won't get a turn. And that is on the probabilities, that's up in the 90%. It's massive. Have a look at the Danielcode archives at the website. I'll show you the link as we go along. Every members chart I've done, I do them all by hand, have been doing them since late 2007 for members. There's over 40,000 of them in our chart archive. You look at them. Remember that some of these target recognition can last for 2 and sometimes 3 days. You will be absolutely flat out finding a market that's ever turned anywhere without prior target recognition. So target recognition becomes your most important final filter. However you're trading, make sure you've got target recognition. It is the most important and the most accurate final filter that we know of anywhere. And it's sitting there for you. Help yourself to it. Subscribe to Danielcode members charts and you'll be able to see all of this as it happens. Okay, let's move on here. And I'm talking about, I've been talking to a number of you about exiting FPC, stands for first profitable close. First profitable open is almost exactly the same. Sometimes it's more, sometimes it's less, it rounds out. But for new traders, your first and most important exit is the first profitable close. And that's because turns by their nature are against the trend. So you can see Wednesday's bar on this chart. We had a TO3 plus sell signal, down it went. That's the turn, but now it's against the apparent trend. So if you want to hold that for longer than that day, and you may say, I didn't make much on it, doesn't matter. You make 1 cent, take it if you're new to trading. But that's against the apparent trend. If you want to hold that, you have to be confident of saying the trend has changed to down. And you're very unlikely to have made that decision based on Wednesday's bar. Nonetheless, and doesn't matter any of that because we had a TO3 sell signal on Tuesday, which was valid and it was elected. So the protective stop on that position, which is 2 ticks above the high that's got the TO3 sell signal on with 1L, do forgive me, it was 3 or 4 o'clock this morning. That's the flip me point. That's your flip me buy right there. I put it on the chart. Very important that you understand flip me. It's a big deal. Here's the Aussie US dollar. This was much easier for you. Here we had a straight TO3 sell signal. If you had done a tutorial, you'd be selling 2 ticks below the inside bar. If you didn't, I would encourage you not to trade the inside bars. Trade the last bar that was not itself an inside bar. Either way, it's a few dollars either way. You got short, straight TO3 sell, very good. Here's the Euro Japanese yen pair. What we had here is we had a TO3 buy signal for Wednesday to be activated on Thursday. And that trade was elected. This market opened and ran up. Lots of optimism and elected that trade. And then it failed. And as it started running down, the second it took out the low of that setup bar, minus 1 tick or 2 if you like. 2 ticks is a habit to me, but technically it only needs 1. That's your flip me point. Sell that thing right there. Its market is telling you you were wrong, and if you're wrong, you need to do something about it. And what you need to do about it is get right. And you did that here by selling. And you had a nice $1,500 profit trade on the second half of this trade. The first part of it was a loser, but you had a nice $1,500 trade after that. Let's keep going. This is Euro USD. Same thing. TO3 buy signal on Tuesday was elected Wednesday. The protective stop on the long position is 2 ticks below Tuesday's bar. When that's hit today, that's a flip me sell right there. And this time it's even got two L's in it, which makes it super valuable. This is the British pound Japanese yen pair. Japanese yen's just been dynamite for a long time, hasn't it? Really simple here, a correlated TO3 sell. Remember, all you Forex guys, if it's got GBP in either side of it, it's going to be correlated. It's going to act significantly the same directionally. It doesn't apply to quantum or dollars, as you could say. It does apply to direction. You had, and what's interesting is usually the correlated trades are a little bit better than the trades that's got the exposed signal. Because it's more complex to see and fewer people know about it. So right here, this market ran down, got down near 177, took flight and ran back up. Still gave us a very nice little profit, $193 profit, not to be sneezed at, very nice. Okay, this is the British pound US dollar. This is cable, it's called cable. And same thing, we had a correlated TO3 buy signal. Then another day up, and doesn't matter if you're still in the trade or out of the trade, look for the flip me point, which is 2 ticks below the setup bar, which was way back on Monday. The trade was elected the next day. Start your count after that, 1 bar up, then the flip me bar 2. If it happens within 3 bars, it's valid to take flip me. I've seen it happen on the 4th bar, but that's getting pretty iffy. The quicker it happens, the better the trade, because it gets more people wrong. This is dollar yen, pretty simple here. Straight TO3 sell signal, nothing could be easier. Down it goes on the next day. That part was nice. Just hang on. And what you've got here, dollar yen, do excuse me, that was a Skype from nowhere. Dollar yen looked nice. You got the nice push down and got short. Today was hard to handle, wasn't it? Because you had the failure point above it. You had, short of killing somebody, I don't know quite what I can do. Do forgive me, folks. I do apologize. There's that was hard because you got the failure was at the bar. You probably got long. Then you had to get short again on the outside bar. Remember, if you get an outside bar on the day of a new entry, you must stop and reverse. And that's really a flip me that happens in one day if you want to think of it that way. Okay, here we are. This is the Russell. What happened here today? Much the same thing. You had a TO3 buy signal. It was elected. Didn't go very far. Didn't give you a profitable close. Today, hit the flip me and down it went, and then pulled right back. Didn't close anywhere near its low. Very confused at the moment. Equities, if you saw what the DAX, Germany's DAX did today, that would really give you something to think about. Here was soybeans. Uh, Pretty simple. TO3 and blue line sell signal. 2 inside bars are prepping itself, down it went. Easy. So is this wheat, very nice. Easy, $1,100. It's important that you see these trades because we measure our success by the money we make. After today's trading, which was very difficult, we've made a lot of money across the range of markets. You have to know how to do this. You have to keep your composure. You have to understand that markets, no matter how zany they may seem at any one time, they are trying to do this to help you. Markets are there to enrich you, to make you wealthy, and keep you happy as well. All wonderful stuff. This is UST bonds, which is very important. The last few webinars I've been talking to you that this has essentially been a battle between the Fed and the bulls, and we had that month-long consolidation there. Eventually it broke down to 122.29, rallied all the way back up to 127.26, and it's now going down. Had a little rally there, TO3 buy signal, got elected on Wednesday. Today, flip me sell signal, right where that initial stop loss was, and $1,250 trade. But this is the market at the moment saying, I'm with the Fed. Interest rates are going up. That's the Fed's argument. That's what's showing here at the moment. But the bears have had some significant victories. Don't write them off. They're still very bullish about everything. The bulls, I should say, that's their nature. But right now, this was the exact opposite of what the bond market did when yesterday was the Fed meeting. It had a weak, muted upward response. Today, down it goes. US dollar index today. Very, very important what it did. Okay, let's keep going. Final reminder, folks, 20% special sale off everything until the 12th of August. Act now. Get subscribed to members charts, or the fourth seal, or TO3 signals, anything you like. Email me to say you've subscribed. Give me a username. I will have the 20% discount in your account that day. Okay, so I think that's getting pretty near the end. This is the chart archives. Go to, you can see the link there, right in the middle gold, below the TO3 plus pending signal. It's in the third bottom line. Is it not fourth? It says chart archives. Go to chart archives. Have a look at those charts. There's over 40,000 of them that I've created for clients in members charts since we let the website go public in late 2007. Over 40,000 of them. You will be hard pressed to find a market that has ever turned anywhere do excuse me. I'm becoming like Mitch McConnell and freezing mid-sentence. A bit of hay fever. Forgive me, folks. Get to the chart archives. Have a look at those charts. They're all beautifully ordered now. And as I say, you'll be hard-pressed to find any market that's ever turned without target recognition. Remember, the business of trading futures and Forex is not to be right, although it seems that way. The business of trading is making money, and that's why we highlight what so many of our trades do. Follow the Daniel code, you will make plenty of money too. If you haven't already, please help yourself to a free trial, and just go to the website, hit the register button, follow the prompts. Any problems, contact Terry at support@thedanielcode.com. If you've had a excuse me. Wattle is blooming everywhere. Australian wattle, beautiful to look at. No good if you have hay fever. If you had a trial previously, the website will probably remember you and it won't want to give you another trial. If that's the case, just contact Terry at support@thedanielcode.com. He'll get that fixed for you. Finally, this is our disclosure statement. Trading futures and Forex is risky. They are levered derivatives. And if you don't know what you're doing, you can lose your money very, very quickly. The industry says that 90% of people lose their first bank in the first 90 days. I think that's a statement. My observation is that people who don't know how to trade lose their first bank in the first 5 days, all of it, 100%. Don't trade until you know how to trade. Once you know money, it's very easy to lose if you don't know what you're doing. By exactly the same argument, money is very easy to make, and a lot of it's easy to make if you do know what you're doing. So I beg of you, do not risk real money until you are confident that you know what you're doing. And the best way for you to get that confidence is do a Danielcode trading tutorial. You will know everything that is worth knowing about trading financial markets. And we've made a lot of these guys and gals into stars. And I'm thankful to say quite a few of them are with us today. So that's it for this one, folks. I will look forward to our next webinar in 2 weeks' time, or maybe before if there's anything earth-shattering. Do email me if there's a particular item you would like me to talk about or find charts for. Otherwise, I will say farewell to you for this session. Enjoy the weekend. You've still got another day's trading to go. I put my orders on, so I'm off the clock. Enjoy your weekend, and I'll look forward to seeing you the next time. Goodbye for now.